What is going on, everybody, and welcome on into the TC Trading channel. So in today's video, we're talking option spreads for beginners. We're covering debit spreads here in this video. We're going to be diving into everything you need to know to start trading debit spreads. And the broker we're going to use as an example is going to be Webull, but you can do this on any brokerage platform that you would like to, as long as you have the functionality to trade option spreads. So you may be asking, what is a debit spread? Now, a debit spread is a different spin on trading options. So traditionally, when you trade options, you're looking to buy a call, buy a put, sell a call, sell a put. But most people, they're looking to make a directional bet on a stock. And so you may buy a call, you think Apple's going to go up. For example, we're looking at Apple right here. You may think Apple's going to go up over $150. You'll buy a $150 call that may expire in a week or 2 weeks or in a couple months, depending upon your time frame. And if Apple makes it up over that $150, depending upon how much you paid for that option, you'll make money, right? So generally speaking, most people like to go that route. Now, if Apple never makes it that far, or Apple gets to that level, but it doesn't make it that much further above, and you ended up paying, let's say, $1, $2 per option contract, and Apple's sitting at like $150.50, you can end up losing money on your option trade. And so debit spreads are a way to trade options where you're able to risk less, but also make less. However, you know your risk reward going in, and the probability of this trade, generally speaking, is a lot higher than if you were to just trade an option contract by buying a call or buying a put. So while right here your risk reward is not going to be potentially as great, or your potential reward isn't going to be as great as if you bought a call option on Apple and it went to 160, your probability of this being a profitable trade is significantly higher, because you don't necessarily need Apple to go up. You may still make money if Apple just sits still, depending upon the spreads that you buy. So we're going to be talking about that here in this video, diving through more details and some examples. Like always, make sure you're jumping down below, hitting that thumbs up button, and subscribing to the channel if you want more videos like this. The options trading playlist is a great place to go if you want more information on options. We have a Greek playlist as well. I would highly recommend you familiarize yourself with the Greeks before you start trading options, and we have 3 fairly simple videos going over the basics that you need to know. So spreads can be very confusing. So in this video, we're going to be talking about how to pick stocks to trade debit spreads, how to identify the debit spreads and the strike prices that you want to trade, how to calculate your profit and loss before you enter a trade so you would know exactly how much you're risking and exactly your potential reward here on this trade. Especially, we'll dive into the max gain, max loss, break even, and of course your risk reward. So when it comes to this video, we're going to be talking about 2 different types of debit spreads. That is the bull call and the bear put. Fairly straightforward. Bull call means we're going to be buying and selling calls, and that is going to be generally bullish on the stock, meaning we want the stock to either go up or stay where it's at. And the bear put means we're going to be buying and selling puts, and we want the stock to either go down or stay where it's at, depending upon, obviously, the spreads and the contracts that we buy. So let us dive right in. The first thing we need to talk about is how to pick stocks, or what stocks we want to pick. Well, number one, you need to understand here is that we want stocks that trade options. So if you're going to be looking for penny stocks, probably not the place to go. A stock like Apple could be a great stock to trade. Stocks that you know specifically or have more experience with, that is where we would recommend you start. The next thing you need to know is what type of volume are we talking about on these option contracts. So if we go to these Apple contracts, for example, we're going to the open interest, right? And we're looking at, how are these contracts, trading a lot of volume? Are there a lot of people who are interested in trading these contracts? And one thing we can do is look at the open interest here on these contracts over on the left-hand side and over here on the right-hand side. We want to see significant open interest. If you're seeing 100, you're seeing less than 100, that's something that personally I would want to stay away from when it comes to options in general. And of course, these spreads, the debit spreads we're going to be talking about here in this video. Now, if you're not familiar with a given stock, or you haven't, don't have it as a long-term investment, it doesn't matter. You can do this with any stock. Just make sure you've done some sort of analysis. You have some sort of thesis on the stock. And this is a trade just like anything else. Like you're buying shares for a long-term investment, you're buying shares for a short-term move, or you're buying an option for a short-term move. This is an option strategy that we can take advantage of week after week after week or month after month after month and consistently profit, because our probabilities here are going to be a lot more in our favor when trading these debit spreads. Okay, so how to pick the debit spread now? Okay, we want to figure out, okay, where are we even looking and how does this stuff work? Well, we're about to dive into an example of what debit spreads are, what you buy, what you sell. Now let's understand Apple here. So all this stuff we need to do before we dive into the actual option chain. And we're going to do that, and Webull makes it super easy to see your max profit, your max loss. So stay tuned for that. We're about to dive into that in just 1 second. We're going to use the app. It's the very same thing here when you're looking at the option chain on the desktop platform, which we're using right now. And we have plenty of videos down below in our Webull playlist going through how to use the desktop platform and how to use the latest version of the mobile app. I'm looking at Apple right now, and I'm doing my own analysis here on Apple. I noticed something right now. I can extend this trend. What am I noticing? Here's a nice trend. We have a very nice trend line on Apple developing over the past couple of weeks, ever since July, and it's mid-September when we're making this video. So since that time, Apple has dipped down to this trend line and bounced. So if I am bullish on Apple, which I am going to be in this situation because we just had a nice little pullback, I like being bullish Apple right now. If I'm bullish on Apple, where is a level that I want to see Apple stay above? Well, if I'm looking at this trend line, it happens to be around that $146 level. Now, I may push that up to 147, which pushes it up a little bit beyond that trend line, but this is going to pay out a little bit better when we start diving into these debit spreads, right, to these option contracts. So I'm going to go with 147 here, which as time goes on, that 147 will roughly be where that trend line is at. So I'm expecting Apple to bounce off this trend line in the past couple of days and go higher. And I think 147 is where it will stay above in the next couple of days and weeks. So we're a bullish Apple. We're going to be going with a bull call debit spread in this situation. Now, the definition of a debit spread means a net debit out of your account. So you are going to be taking cash out of your account balance and using that for this position. We're going to have a video on credit spreads, actually, I believe next week, so stay tuned for that. But with credit spreads, you're actually getting paid initially because what you're selling is higher value than what you're buying in terms of the two option contracts. But in this case, what we're selling is less than what we're buying in terms of the contracts, and so we're going to have to net pay an amount out of our cash balance to enter this position, and ideally, we'll be able to make money on this spread. So we talked about being bullish, bearish. We talked about that 147 line in the sand that we want to see Apple pushing above or staying above in the coming weeks. Now let's pick our strike prices, okay? So let us dive in to Webull. Let's talk about some strike prices and how to do this, and then we'll dive through the calculations, like the break even, the profit and loss, all that stuff. All right, so now I'm inside the option chain on the Webull app. What I'm going to do is I'm going to put this to just the call side. At the bottom of the screen, there's an option to select calls because we're looking at calls here just to make it simple and easy to see. What I have selected here is vertical, right? So I have a strategy under the options chain that is selected as vertical. This is what you're going to want to select when looking to place a debit spread position, right? Or enter a debit spread position. Okay, so we have to look to the left-hand side and we want to see that Apple is going to stay above that 147, right? So we're looking down in here to the left-hand side, and let's see this 146 and 147. So we click on this, and of course we can edit this. So don't worry, we can of course always edit this, but let's start understanding what this means right here, and Webull makes it very easy to see. So when entering a bull call debit spread like the example we're using for Apple, where we think it's going to go up, we want to be talking about and trading the options below where Apple is roughly at right now, or below where we think it should hold above, okay? So we're looking at the 146 and the 147 strike price, and this right now is expiring on the 17th, which is actually 2 days from when we're making this video. We can actually talk about a different example. I'm going to push this out to October, which gives us a couple more weeks in terms of time on this, and I think it will be easier to see. So what does this mean for Apple? We are going to be buying the 146 strike price option, and we're going to be selling the 147 call strike price option. Both calls, we can see that here on the screen for Webull. It's important to note that both of these contracts are in the money because Apple is currently trading higher than where it's at. Apple's actually at 149 as we speak. These are both in the money, and so given that they are both in the money, the stock or the option contract that is further in the money, the 146 contracts, those are going to be of a higher value, okay? So we're buying those and we're selling the 147s, which are of a lower value, okay? So this is what we're looking at when it comes to a debit spread. Now, on the screen in front of us, it's going to give us a max profit of 28 and a max loss of 72. Let us now explain how we come to those numbers, how you can calculate this, and does this make sense in terms of a risk-reward standpoint. Okay, so here we go in terms of calculating the max gain, the max loss, and all of that stuff when it comes to a debit spread. I want people to understand this because it's actually quite confusing until you start to see it drawn out. So our Apple price right now is currently $149 per share, okay? We are looking to buy the 146 strike and sell the 147 strike. This is going to result in the 146 strike being more pricey, which means we're going to have to pay money out of our pocket. In terms of understanding this, you can look at both of these option contracts individually and understand how much they're going to cost, but Webull is going to do the hard work for you, and they're going to put the vertical chain, right? They're going to show you the options in the vertical strategy, and they're going to show you this with already doing that math for you. Now, what is that math? It is the difference in terms of what you're buying this contract for and then what you're selling this contract for. So for the October 1st, 2021 example we're going to be using in this video, we are looking at the Apple 146 by 147 spread. So we're buying the 146 and we are selling the 147s. This is going to cost us, as of right now, this is currently trading for 72 cents. What does this mean? This means that the difference between what we bought and sold for is going to cost us out of pocket 72 cents, which is equal to $72 per spread that we want to buy, okay? So it's going to cost us $72 out of our account, okay? That is something you must absolutely know. This is also your max loss, okay? So when looking at debit spreads, I think it's a great place to start first before credit spreads because your max loss calculation is so much easier. It is all that you pay for this spread. That is your max loss. Now, calculating your max gain. How do you calculate your max gain in this scenario? So max gain, okay, that we're going to calculate right now is the difference in the strike price, okay? So right now we have a 147 minus the 146, okay? So you take the strike price that you sold right here, the 147, you subtract the 146 strike price, that's going to give us $1, okay? You take that $1 and then you subtract your debit, which is up here. You then subtract that 0.72 cents. This ends up giving us a max gain of 0.28, which is equal to $28 per contract, per spread, okay? That is our max gain. How do you get that max gain? That means that Apple must close over the strike price that we sold. Apple must close over this 147 strike to give us this max gain right here. Now, I want to refer back to Webull to talk about how we now can understand our break-even price. In this example, we're actually going to see that Webull is going to have it up on the screen in front of us. They're going to give you the break-even price in this situation, which is why I love using the app, and also you can get access to this on the option chain as well. This on the desktop platform. This is going to show us right now that our break-even price, okay, so let me just write this down right here so you guys can see. Our break-even is 146.72. Why is that interesting, or why is that familiar, right? Well, that's because it's going to cost us this 72 cents for these contracts, and if all goes right, our max gain is 28 cents or $28 in this situation. And for us to break even, for us to get back what we put in, not make any money, not lose any money, Apple would have to close at 146.72. So it technically could close below 147 or be below 147 and we could still be green. However, if it's below 146.72, that's where we start headed down towards that max loss of that $72. But again, Apple would have to then go below 146 for us to achieve that max loss. So you may be thinking now, okay, that was a lot, but you may be thinking, well, why would I risk my $72 to make $28? Well, it's because there's a much higher probability of this happening. In this situation, right, Apple is trading $2 higher right now as we speak than where this is sitting. So if Apple just sits still, it doesn't have to go up. It can even come down $1. It can even come down $2. We're still going to achieve our max gain. That means Apple closes over that 147. That's our max gain. So all you need to understand here when it comes to max gain is your max gain is achieved if the stock on a bullish call option spread closes over the option that you sold, which is the higher strike price, okay? The higher strike price. Now, if we're looking at a bear put debit spread, what you're going to be selling is you're going to be selling the strike price that is technically lower or closer to the money than the upper that you'll buy. So again, you're paying more for the option you're going to buy than what you're going to sell on the bear put debit spread. And let's talk about that example right now. Okay, so now for the bear put example. So when it comes to a bear put, we want the stock to go down, which is great, or it has to stay below a certain price point. So in this example, let us use a hypothetical stock that is currently trading at $50, okay? So it's a $50 stock price, okay? That's what we're looking at, okay? What we are going to do for a bear put debit spread is we're going to buy a strike price that is higher than what we're going to sell at. So let's say we want to buy the $53 price, okay? This is a strike price we're going to buy, strike, okay? And we're going to sell the 52s, okay? So we buy the 53s, we sell the 52s, and now what do we have? We have a bear put debit spread. So how do we make money on this? How do we achieve our max gain? This stock must stay below $52 per share in order for us to achieve max gain. Now, let us say hypothetically where these are trading at. Let's say that this $53 put is trading at $3.75, and the 52 is trading at, let's say, $3. Now, of course, it's just hypothetical, but let's just say that that's what they're trading at, okay? So this is kind of going separate from letting Webull do the calculations for us and giving us what it costs. This is all we need to know, okay? So this is going to cost us 0.75, 75 cents. That is the debit out of our account. We need to have 75 cents or $75 in this case per contract that we are looking to buy, okay? So that is a debit. Now, how do we calculate our max gain? So in terms of calculating max gain, we need to understand the difference in the strike. So we're going to take the 53, the strike price that we bought, the 53 minus the 52, minus the strike price we sold, which is going to give us $1 again in this example, okay? That $1, we then take that $1, okay, and we subtract the debit that it cost us, okay? We subtract the 75 cents, and we end up with 0.25, 25 cents, or in option terms, right, in terms of contracts, in terms of our actual, what we have to pay out of pocket here, 25 bucks, okay? So our max gain here is $25 if this stock stays below 52. Now, again, it's trading at 50 right now. As long as it stays below 52, that's great. So again, this is why these are really cool, because not only are we kind of placing a directional bet, because if it goes down, great, we make money. If the stock ends up down in the 40s, we're fine, right? We're not only placing a directional bet, but the stock could actually come up or kind of stay steady, and we're not going to get bled out on those option contracts due to time decay and whatnot, right? Because if, let's say you're buying a $50 put, right, it might be expensive now, but if the stock doesn't move and this put expires in a couple weeks, this stock hasn't moved, that put's actually going to lose some value. It's going to have intrinsic value if it's in the money, but it's going to end up losing a good chunk of value. So we don't have to worry about that here when it comes to these spreads, which is why it's really cool. Now, what's our break-even price right here? What's our break-even? How do we calculate that price? Well, to calculate the break-even price, you take the strike that you bought, so the $53 strike price, okay? Take that strike price that you bought it for, the contracts you bought, you subtract the $53 strike minus, you subtract how much it costs you. So the debit, subtract 75 cents here in this case. And what are we left with? We are left with 52.25. So as long as this stock stays below 52.25, we are going to end up making money on this play. And at 52.25, we break even. And then if the stock ends up going above 53, we hit our max loss, and our max loss would be that $75, that 75-cent debit that we originally had. So again, this is actually really cool because, okay, yes, your risk reward here isn't perfect. It's not like you're able to risk $1 to make 20. No, you're not doing that here, but the probability is a lot more on your side because in this example, the stock still has to go up $2+. Actually, in this case, $2.25 from where it's trading right now at 50 bucks for you to lose anything or for you to break even and then eventually lose. Now, if you think it's going to go down based on your analysis, your technical analysis, or your fundamental analysis, then this should be a pretty low stress trade as long as it stays steady or ends up falling down. So this option strategy eliminates the time decay aspect of options, and we can take advantage of and profit off of that time decay if things sit still, which is why we like to trade these things. So there you guys have it. I know it was a lot. I know it may have been confusing, but the example we used at the end, if you need to go back and replay that, go back and do that. That's essentially doing the math out that Webull does for you on the app or on the desktop option chain platform. Okay, so they're going to do a lot of that for you, but it's a good idea to have an understanding of the math behind the scenes so you know what's going on behind the scenes before you just start buying contracts. And you know that when you're buying these contracts, when you're buying these spreads, you know exactly what you're getting into and you know exactly what needs to happen for you to stay green on that trade. Thank you guys so much for tuning in. Hit that thumbs up button. Consider subscribing. Again, check out those other playlists, those other option videos on the channel already. Any questions about Webull? We have some great videos and a playlist diving into a lot of the features that they offer. Let us know in the comment section down below. We can definitely make more videos on this stuff because it's kind of in-depth and it's really interesting. And stay tuned for the next video on credit spreads. Thanks so much, guys, and we'll see you in the next one. Peace.